fiscal policy, there are log jams all over the place in Washington, whether we're talking about the debt ceiling. No, we're not going to shut the government down. They play this game almost every year. I think the cash is there until October 18th, maybe a little longer than that. So it's going to be an interesting couple of weeks, but we think they'll get the job done. They have no choice but to get it done. The infrastructure bill and the $3.5 trillion bill, social infrastructure bill, as it's called, those are also stuck in gridlock, very interestingly, and not just the gridlock between Democrats and Republicans, of course, but the gridlock that appears to be evolving between the progressive and moderate Democrats in the House. So as we have been expecting, with midterms roughly a year away, but the campaigns beginning now, we would be very surprised to see much in the way of serious tax increases go through. We thought for a time that perhaps there was some momentum building behind some of these tax increases, but that has stopped, it seems. And one of the reasons is polling of the swing states would suggest that those voters do not want their taxes to go up in the way that Congress is proposing. And I think that is going to matter. So that's good news for the stock market, actually. Monetary policy, the growth rate in M2 peaked at 27% earlier this year and has dropped to 13.4%. Last month was a little lower, but low teens now. So the big question about monetary policy is when are they going to taper, meaning when will they stop quantitative easing, just buying bonds, and when will interest rates go up? Well, if our outlook is correct, neither one of those is going to happen. Maybe we'll get some tapering. And we've discussed before that we do not believe that's going to make much of a difference. The easing or the quantitative easing that we have seen, a lot of that is just stuck on the central bank's balance sheet in the form of reserves. So they're kindling for loan growth. And if we were to light the kindling, meaning banks went crazy loaning money out, well, then we might have a boom, actually. That's not happening. In fact, quite the contrary. We are beginning to see the banks worrying about loan growth because of DeFi, decentralized finance, and the crypto world. And we do believe there is a lot of reason to worry. Regulators are going to insinuate themselves into that process, of course, and we'll see what happens. But DeFi is flying. Just to give you a sense of that, last year around this time, there was less than $10 billion locked in DeFi on the Ethereum network. Today, that is $120 billion. So at the margin, that is making a difference for the banks. We believe that the next big worry is going to be recession. We don't necessarily believe there will be one, but if we're right on what's going on out there, and inventories are starting to build up. We've been saying for some time that the inventories in the system are much, much higher than I think most people appreciate. But where are they if they're not in the auto dealer lots? Well, they're in our garages and in our driveways. Everyone knows the familiar story of stocking up on paper goods. We're not going to have to buy them for quite some time. So a lot of inventories are in households. We believe that, and if we're right, there will be too much inventory, we believe, on the shelves. We're beginning to get some rumblings of this this week. Kohl's and Bed Bath and Beyond were hit hard. And I do believe that, and one of the reasons were downgrades. I think analysts are beginning to sniff out this excess inventory and the loss of demand as consumers move from goods, at the margin, of course, to services. We also think there's another fear brewing out there, and it's China. Now, we hear a lot of headlines about China, but I'm not seeing many economists even integrate what's going on in China into their forecasts. China has been a powerful growth engine for the global economy for the last really 20 years. And they are changing their spots. Growth does not seem to be China's primary objective anymore. Common prosperity does. And they are restructuring in many ways. I think that's going to slow things down quite a bit, their economy. And of course, China has an impact not only on the rest of Asia, but especially Europe. I think Europe and China are much bigger trading partners than China and the US. Nonetheless, commodities are global. And so what hits China and these other economies is going to impact pricing. In fact, we're already seeing that. As you know, in our world, we're looking 5 years out. And we assume massive multiple compression over that time period to get to our price targets. Well, the market is really worried about inflation. And the headlines this week have been the highest rates we've seen in 38 to 40 years. And for some measures, that is true. I mean, the headline measures are concerning. I understand that. The PPI year over year is up 8.3%, CPI 5.3%. The personal consumption deflator up 4.3%. That last one is the one that the Fed pays a lot of attention to.